Welcome to Market Catalysts, everyone. I'm Brad Smith. We are 30 minutes into the U.S. trading day. Let's get to three market catalysts that we are watching this hour. First up, the S&P 500 and the Nasdaq opening at record highs. We bring you the market outlook with stocks powering higher right now. Plus, we break down the outlook for rate cuts from the Fed. Their favorite inflation gauge, it came in a little bit hot this morning. We'll break that down for you. Plus, we bring you the stock to watch this hour as Tesla shakes up its upper ranks ahead of deliveries data that's due out next week. Let's get a check of the markets here 30 minutes into the start of trade and taking a look at the major averages right now. We've got same fresh record highs here. Take a look at the S&P 500. That's higher by about 0.5% right now out of the gates here this morning. And then additionally, take a look at the Nasdaq. You're seeing that up by about 0.4%. We'll round that off to the Dow Jones Industrial Average, also seeing some solid gains fractionally. It's up by about 0.7%. Let's flip on over to the bond market here, taking a look at the 5, the 10, and the 30-year. All of those moving higher right now as well. You're seeing about 4 basis points added on for the 5-year, 3 basis points for the 10, and 2 for the 30-year yield this morning. Well, the U.S. and China have signed a trade deal. President Trump announced late Thursday.
Remember a few months ago, the press was saying, do you really have anybody of any interest? Well, we just signed with China yesterday, right? Just signed with China. We have everybody.
In a statement, the Chinese Commerce Ministry said Friday that the two sides had confirmed details of the trade framework. They also said officials would review exports of controlled items, but there were no explicit details about access to rare earth minerals, materials that are crucial for U.S. manufacturing. Commerce Secretary Howard Lutnick told Bloomberg TV the deal with China was signed earlier this week, adding that China would deliver rare earths to us. Lutnick added that the Trump administration is near agreements with 10 major trading partners. These headlines come ahead of the Trump administration's self-imposed trade deadline of July 9th. That would end a pause on reciprocal tariff levels. Thursday, the White House said that deadline is not critical.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline.
And we'll continue to bring you the latest trade news as it breaks and potentially moves markets. Joining me now for the next 2 hours, we've got Simeon Hyman, who is the ProShares Global Investment Strategist. Simeon, great to have you here with us this morning. First, let's just begin with this because we're going to start with the trade deal news. And of course, over the next hour or two, we will work through a lot of other conversations. But what do you make of the trade deal news right now between U.S. and China and potentially 10 other deals that could come forward?
Look, it's good news. I mean, when Liberation Day came out, that was beyond what many had assumed, even given all the rhetoric about tariffs that Trump has said for years and years and years and decades. So coming to something that's just perhaps a modest uptick in tariff levels that would in effect represent just a modest tax on broad ranges of the economy certainly will help, and it certainly helps importantly with keeping inflation a little bit in check over time.
So one of the things that's really started to come into the mindset of investors is what the effective tariff rate is over an extended period of time. What's the analysis that you've been able to run on this over at ProShares?
I don't think we know,
Yeah.
but something like 10% as an overall increase in tariffs, and there's going to be 25 here and nothing over here,
Sure.
certainly seems in the cards. That's not the kind of thing that derails the economy, but it is the kind of thing that will likely stop inflation from getting all the way down to that 2% target of the Fed.
You know, with this in mind, as we're thinking through which countries we would still need to see perhaps an outsized collection of tariffs from those countries, and then us getting a better tariff rate. What does that checklist look like from your mind, especially considering our trading partners that we do the most business with?
Well, I think the notion that we have, that there is a potential of idealized complete free trade around the world, we know doesn't really exist. And we also know that every country subsidizes some industries. Even the most free market capitalist countries in the world will give a little money to people who make cheese, give a little money to people who make soybeans, maybe a few dollars for somebody who makes a jet plane. So there's nothing perfect in the world. But if we have a relatively low and modest increase in tariffs, particularly let's keep an eye on Europe because that's going to be the last one to get done.
If tariff deals get done, how much of that is a market catalyst for the second half of the year? What does the market look for in order to find its next big catalyst?
Well, the market's incredibly resilient. And by the way, I point out, importantly, even beyond the tariffs, in the first and second Gulf War, the S&P ended the year up almost 30%. So the market can be quite resilient even in the face of conflicts, but also on the tariff front. So if it stays modest, that should allow, hopefully, earnings to hold up when we're just starting the earnings season right now. So that's going to end up being key.
And so with that in mind, how different a tone do you expect to hear from companies who were highly uncertain, as we know the tariffs were originally rolled out, and then ultimately now coming into the next earnings season trying to get a sense of where they might have a little bit more clarity where they did not before?
I think what we saw in this morning's economic data is telling. So we saw just a little bit more inflation than people expected in the PCE inflator, but we did see weakness in consumer expenditure, and that's why we're not seeing a sell-off in the bond market. So I do think that you're likely to see a smidgen of weakness on the consumer side emerge in the second half.
It's interesting, especially as we're watching this morning here. We've got fresh record highs for the S&P 500 and the Nasdaq. As you kind of look into your crystal ball for the back half of this year, what is the core driver that investors should be looking for in order for these not to just be record highs of right now, but also for future record highs to be hit? As we know, it's the back half of the year, the Q4, that typically sees the most topping out of the market.
I'll submit the following as kind of a way to frame this. The market might not be perfect, but it's not stupid. If you look at profit margins as an example and returns on assets and equities from 20 years ago, they are about 50% higher for the S&P 500 and almost double for the Nasdaq 100. And by the way, 20 years ago, the Nasdaq was trading for the same 29 or 30 that it is today. So I think the quality of the earnings, how well the earnings translate into cash flow, which means margins and balance sheet strength, are going to be important to do that block and tackle analysis of all three financial statements when those earnings come out.
Is there one part of this market that you think is set to outperform in the back half of this year, either on an individual or sector basis?
Look, there have been laggards in this market that has been so Mag 7 driven. We know that some of it is supported by strength, but there are other pockets that have been left behind, and particularly as interest rates have receded, they might not go much further, but they are lower than they were a year ago. Areas of the market like dividend growth stocks may certainly begin to catch a bid as we move into the second half.
Interesting. All right, spicy start, Simeon. We've got much more to discuss here throughout the morning. We've got all your markets action as well ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Amazon, Alphabet, and Estee Lauder. First up, Amazon getting an upgrade from BNP Paribas to outperform from neutral, and the analysts saying that they are optimistic the tech giant will top profit expectations in its next earnings report. The company also announcing a new tool for its Ring doorbell camera, AI-generated summaries that inform users of potentially suspicious activity. I'm going to bring back in Simeon Hyman, who is the ProShares Global Investment Strategist here. As you think about Amazon here and where they've sat not only within the Mag 7 trade, but also within this broader AI trade at the same time where they're susceptible to the mindset of the consumer on the e-commerce side of the business, where we know that's not the one that's generating the lion's share of the profit margins for the company as a whole.
Yeah, they have a couple of different things going on there. And just before the break, we talked about the weakness this morning a little bit in the consumer spending. And there is a decent chance that we'll see a little bit more of that in the back half of the year, even if the tariffs are on that low end of where the bar might have been set on Liberation Day. That still can take a nick out of consumer spending. The AI trade doesn't seem to have any slowdown in front of us. We're waiting to see the productivity implications, but it's an arms race right now.
Absolutely. Meanwhile, BNP Paribas downgrades Alphabet to neutral from outperform. The analysts see short-term risk for the company's earnings. Back in April, Alphabet saw its quarterly revenue impacted by a slowdown in sales, mainly in its cloud computing and devices. The company's core business is also being threatened by regulatory challenges. Shares of Alphabet, they're still holding on to gains. They're up by about 0.7% on the day. You talk about a business that is still, by and large, the majority of its revenue advertising dollars, but the differentiation or diversification of its revenue streams here now leaning more into, of course, on the hardware side, the Pixel phone and some of the other devices that they can bring to the consumer market. And then additionally, at the same time, trying to ensure that for Alphabet and how they are kind of looking across other strategic bets that they're making, that they're not spending more, then that's impacting some of the profit margin that investors have come to expect at this point.
I think still one of the things that intrigues me most about the market over the last several years is how it differs from what we experienced in the late 90s. The famous book that was called The Innovator's Dilemma that came out in the late 90s. And the premise of the book was that technological innovation could not be capitalized on by incumbent companies because it threatened their existing cash cows too much. They just couldn't figure it out, and disruptive companies would come in. But this time around, they're not so young, the Mag 7. These are companies that have been around for 20 or even 50 years.
Right.
So I think that it's very different this time because so much money is needed. Yes, you see a few new names here and there, but I think the moats around the amount caused by the amount of money that it requires to stay in that AI game is protecting the folks who aren't quite as young as the disruptors of a generation ago.
That's a really good point, and you've just added to my summer reading list as well here, so 2 in 1. HSBC upgrading Estee Lauder as well. We're tracking this buy rating and raising its price target to $99. The analysts expecting the beauty products company to double its earnings between 2025 and 2027, mostly due to its cost-cutting and reorganization efforts. Shares of Estee Lauder up by about 3.3% right now. As we think about where Estee Lauder typically sits within the consumer mix, right now it could even still be seen as one of those little luxuries that consumers, if they're not purchasing some of the big ticket items, that, hey, maybe I'll still go out and get something that helps with my self-care mindset, if you will. And that might be where Estee Lauder is still seeing this potential momentum over the next few years here too.
There's still a bifurcation of the consumer in the U.S. and around the world. And to the extent that there are the classic bite-size or lower-end luxury brands, we always used to talk about Coach in that kind of framework. There certainly there may very well be an opportunity for those firms to do a little bit better when the consumer slows than, paradoxically, perhaps the folks who are on the bargain end of the spectrum.
Absolutely. Well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're getting the latest read on all things policy from Washington, D.C. The Fed's preferred inflation gauge, PCE, coming in hotter than expected, up 0.2% month over month, 2.7% year over year. This as the deadline for President Trump's tax bill looms. Joining me now, we've got Yahoo Finance Fed correspondent Jennifer Schonberger and Yahoo Finance's Washington correspondent Ben Werschel. Jennifer, let's start with you. What does this mean for potential rate cuts this year?
Hi, Brad. This morning's reading on the Fed's preferred inflation gauge showed prices ticked up slightly in the month of May, but didn't show a big upswing in prices caused by tariffs. And this is something that the Trump administration is likely to tout, that inflation remains mild in the face of tariffs, and the Fed should be cutting rates. Despite the increase in core inflation, it was too mild to set off serious concerns that tariffs are starting to push up prices. This week, Fed Chair Jay Powell told lawmakers that he doesn't believe the Fed has seen the impact of tariffs on inflation so far and is watching the impact through the summer months. The implication is that if inflation continues to clock in mild through those summer months, that perhaps a rate cut could be in play in September.
If it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, meaningfully weaken in a way that was concerning, that would matter for that decision.
The Fed is very divided right now over when to cut rates and by how much. Fed governors Mickey Bowman and Chris Waller have both said they could support cutting rates as soon as the next meeting in July. Fed up, no pun intended, with the Fed not cutting rates yet, President Donald Trump is said to be looking into announcing a new replacement for Fed Chair Jay Powell as early as this fall, according to people close to the administration I have been speaking with. And that is said to be a shot across the bow at Powell for not cutting rates. Brad?
Yeah, particularly interesting as we were discussing yesterday, as it could potentially create a situation where you've kind of got a shadow Fed even that starts to make itself known. Even if we were to see that early announcement, we still do have until May of 2026 where Fed Chair Jerome Powell, that's when his term is set to expire. I want to also bring you in, Ben. Congress has a week to iron out the details of President Trump's mega bill, and it sounds like the big, beautiful bill, as it's been dubbed, may be heading in a more beautifully expensive direction,
for sure.
Perhaps.
Bigger and bigger. Yeah.
Yeah,
for sure. So this bill is changing, Brad, by the hour here, and there's a lot of negotiations going on, and a lot of changes are happening for a lot of different reasons. But one commonality that I'm looking at this morning is this price tag question you mentioned. A lot of these changes are happening, all of which could push the price higher. Just in the last 24 hours, two major examples of this. One was a Senate parliamentarian ruling about the Medicaid provider tax. This hundreds of billions of dollars in cost savings that she says can't be in the bill as is. They're trying to revise it, they're trying to get it back, but that's a major blow to the kind of price tag side of this. The second is what's being called a revenge tax. The White House requested that be stripped from the bill, and lawmakers have complied, but that's another $100 billion plus. There's more examples from earlier in the week around the Supplemental Nutrition Assistance Program, and that's not even to mention the SALT state and local tax deductions that are ongoing as we speak this morning, and there's a lot of going back and forth there. How that resolves is another couple $100 billion. The bottom line here is that the question here is not whether this $3 trillion bill gets more expensive. It's emerging that it's going to be kind of how much more expensive it gets. So there's a full accounting of this won't be available for days, but this goes right at the objections from a lot of fiscal conservatives in the House, not to mention the bond markets, I'd add, who are watching this closely, who have raised questions about the price tag of this bill. And if we get a much bigger number, once this is once these are all compiled, it could change how this moves forward.
Jennifer and Ben, thank you so much for taking the time here to break this all down. The Fed's preferred inflation gauge coming in a bit hotter than expected in May. Core PCE moving further away from the Fed's target, rising 2.7% year over year. How much cold water does this pour on those with hopes of a July rate cut? Joining me now, we've got Greg Dacko, who is the EY chief economist. Greg, good to have you here with us. So let's just start with this question, because that is the real consideration here, is what this data ultimately means for the evaluation as per the lens of the Fed. What do you anticipate?
Well, I think generally speaking, we are still seeing relatively tame inflationary pressures going through the first half of the year. But we are going to see an inflation reacceleration that will be tariff induced. We know that tariffs are gradually rising in terms of the effective tariff rate. You were just talking about the fact that the effective tariff rate is around 10% as of the month of June. The average tariff rate announced is around 15%. So there's more pressure to come into the economy, filter through to prices, and lead, unfortunately, to income erosion and consumer spending slowdown. That is really the picture that we should expect in the second half of this year.
Based on what we've seen and how consumers are thinking about their spending habits right now, how long of a tail does that typically have when we have shocks like the onset of tariff policy conversations, negotiations, waiting for deals, and then ultimately waiting for businesses to potentially roll back some of the costs that they've then passed on to consumers?
Yeah, typically speaking, you tend to see a bit of a lag between any type of announcements of any tariffs and the effect on consumer spending activity. The reality in this instance is that we've already seen the intangible effect of uncertainty affecting consumer spending activity, affecting business investment. The fact that we continue to have a lot of policy uncertainty with regards to trade policy, tax policy, immigration policy, and regulation are all constraining business investment and consumer spending. But now, unfortunately, we're going to start to see the price pressures filter through. We're already seeing furnishing and furniture prices rise. We're already seeing recreational goods prices also start to rise. This is just the onset of this inflation reacceleration, which will take a bite out of income. You look at real disposable income as of the month of May, it's rising at a 1.7% year-over-year clip. That's relatively slow, and that is bringing down consumers' ability to spend in a higher price and higher interest rate environment. So I'm a little bit concerned about the outlook for the second half of this year. I wouldn't be surprised if the economy moves towards a pace of growth that was around 2.5% in the first quarter, towards a sub 1% pace by the end of this year. And I would argue that this should favor more Fed easing as we navigate the rest of the year.
Okay, so I'll just follow on that and then I'll get to my next question. How soon do you think we may see that easing?
Well, I think we should not expect a July rate cut. I know this has been reactivated in terms of a potential timing for the next rate cut, but the bar is still relatively high. Yes, Governor Waller and Governor Bauman have argued that a July rate cut would make sense, but the majority of the FOMC voting members are not on board with regards to a July rate cut. I think what's much more likely is a September rate cut, because by then we will have seen more demand erosion. We will have seen a labor market that unfortunately has slowed, and income growth as a result has slowed, leading to slower consumer spending activity. There will be reemerging inflationary pressures, but unfortunately the Fed is going to have to decide to err on the side of caution, focus more on the growth slowdown, because the inflation effect is likely to be short-lived. I anticipate no or limited second round effects in a weaker labor market, so that wage growth does not accelerate and the inflation shock is not as persistent as what we experienced after COVID.
And so as you're talking about the concern of inflation reacceleration, there's also the concern of data quality. This came up in Fed Chair Powell's two-day testimonies that were taking place on Capitol Hill. And we'd also seen this raised on June 20th by Torsten Slok, the Apollo chief economist, saying that in May, the share of data in the CPI that's estimated increased to 30%. The significance of that is that you've got these BLS teams that collect roughly 90,000 price quotes every month covering 200 different item categories. And then additionally, when data is not available, they typically have to develop estimates for approximately 10% of the sales. So that going to 30% puts in question this broader data quality here. So what is the true read that we should be anticipating, and knowing that PCE is the Fed's preferred inflation gauge, how much more pressure does that put on some of the future CPI readings, knowing about that quality in the data that's been alleged and come forward?
Yeah, certainly. I mean, we recently hosted a podcast with Laura from Macro Policy Perspectives on the NABE podcast, and we discussed that very topic. Where essentially the BLS is increasingly having to impute data when it comes to prices. It used to have to impute 15% of prices. Now it's looking at 30%. And some of that is due to reduced funding. The broad picture is that we are going to be in an environment where we're going to see increased fog in the data at the same time as there is increased fog from policy uncertainty and from really significant movements in terms of tariff announcements. And so that is a combo that is not ideal for anybody that is looking to plan for the next few years, anybody that is looking to adjust monetary policy, and anybody that is trying to gauge the direction of travel of the economy and of where inflation is headed. So the combination of all of these uncertainties is really potentially hurtful to the economy and to policymakers' ability to come up with the optimal policy in this highly uncertain environment.
Greg, great to see you. Thanks so much for taking the time, as always.
Thank you. It's been a pleasure.
Likewise. All your markets action straight ahead. Stay tuned. You're watching Market Catalysts. 1 hour into the start of trading, let's go live to the Nasdaq to get a read on the biggest factors moving markets today. Joining us now, we've got Yahoo Finance's Ali Canal up there in Times Square. Hey, Ali.
Hi, Brad. Well, I'm watching for those records here, especially with the benchmark S&P and Nasdaq composite. Right now, if these gains hold, we will be aiming for fresh all-time highs here. So here's the numbers to look out for. The S&P 500 needs to top 6,144 to notch that new record. Again, we are trading at those levels right now. That was the peak back in February, and the Nasdaq's aiming for 20,174, which would be ahead of its all-time high that it reached in mid-December there. So both indexes up about 0.5%. We are seeing the Dow Jones lead markets higher today, up about 0.7%. And speaking of records, we know that tech has really been dominating over this past month. And to that point, Nvidia trading now above $157 a share. That is a new record for this stock. The valuation here is just around $4 trillion. Analysts that I've been speaking with say that it's very possible we could see a $6 trillion valuation for this company, and that at these current levels, even though we're at all-time highs, this company might still be undervalued within this broader market here. So that is one stock I'm watching, but I also want to take a look at the trending tickers page, because Nike is the #1 trending ticker on Yahoo Finance right now, and for good reason. We're seeing shares up over 14% at this point after a better than feared earnings report. We know that the turnaround plan from Elliott Hill is starting to take shape. The company did warn of a $1 billion hit due to tariffs, but the fact that we now have that US-China trade deal on the table, that's removing some of that worst case scenario and the risks there for that stock. A year to date coming into this market open, we were down about 17%. Now, thanks to these roughly 15% gains, we have a much modest loss since the start of the year here. So Nike, one stock to continue to track if we do see that V-shaped recovery, with the worst potentially priced into this name.
All right. Thank you so much, Allie. Sticking with Nike. Nike surging after fourth quarter results came in better than feared. The retailer topping estimates on the top and bottom line despite seeing sales drop 12% year over year, saying this quarter saw the largest financial impact from its turnaround plan. Joining me now, we've got Randy Connick, who is the Jefferies retail and apparel analyst. Randy, good to have you back on the program with us. You have a buy rating, $115 price target on this stock, so there's got to be a lot of work done between here and there. You see this as an inflection point for Nike, though. Take us into your thesis.
Yeah, look, I think what the market underappreciates about this business is, and first and foremost, Nike is the second most ubiquitous brand in the entire world behind Coca-Cola. In addition, Nike competes with only 10 companies in athletic footwear. That's a great position to be in. And not only is it's #1 in footwear, well, not a lot of competition, it also had self-inflicted wounds, and those self-inflicted wounds incurred by a prior CEO are now being fixed with better product, more balanced distribution. And because earnings got cut in half and a lot of these issues were self-inflicted, those earnings can bounce back rather quickly. It's not going to take a quarter, but over the next 8 quarters, we think this V-shaped recovery ensues, and that's what makes this stock nearly double from current levels over the next 12 months.
So let's take this in pieces, because there have been a couple elements of this turnaround strategy, and I want to start with how they're looking across their partnerships, especially on the retail front. What have you been encouraged by? What would you like to see more of? How are you evaluating that?
Look, I think it's as simple as, first and foremost, the company's getting back into the retail channel and enlarging its wholesale distribution. Under the prior CEO, they went away from that. So the new CEO is doing a good job of rebalancing that distribution. In addition, the company's really doing a good job of talking about being a better partner to the wholesale channel, not just taking, but also giving. So that means co-marketing with the partner, but also means doing a better job of segmenting product for each specific retailer, which I think is a very smart move. Finally, with the return of going back on Amazon, I think it just helps the company broaden out its customer base. And again, allows Nike to kind of, because it's a ubiquitous brand and people want to buy it everywhere, it allows the brand to shine through in these different retailers, these different channels, so everyone can get the new product that looks more compelling.
There's been a ton of focus around that product and the inventory levels of that product. As you're monitoring what the consumer trends are right now, especially across regions, and I believe it was EMEA that's actually showing the most strength and momentum for them right now, what do they need to see in terms of that inventory and how they're kind of navigating those shifts internationally to ensure that they've got the right product in the right place at the right time?
Look, it's a great question. I think what the company is doing now is they're acting with urgency. So inventories ended the quarter in and about flat. Now, they did talk about some elevated inventories in particular regions, in particular product categories like the lifestyle products. But what they did also say is they're doing a good job of getting through that product in a timely manner, such that from an inventory perspective, you should see inventories be very clean within the next couple quarters, which allows for the back half of the fiscal year to be set up for a business that goes up against very easy comparisons on top and margin line to show some really meaningful improvement as we go out a couple quarters from now.
Just lastly, before I get to some of the other names that are in your coverage that are moving on this Nike report as well, for Nike, there's been this emphasis on leaning into the Jordan brand. We've seen that. It's played out. Even my sources within the company reiterating how much this is going to be one of those key drivers or catalysts for the business going forward. What does that mean for the other brands that fall underneath the broader Nike company?
Look, I think as it pertains to Jordan brand, look, it's a great brand. And they just had a problem where Nike emphasized too much on the Air Jordan 1. So what the company is doing is pulling down inventory on the Air Jordan 1 franchise, but then also looking to diversify into other parts of the Jordan lineup, if you will. While that's being done, the company is distorting efforts on product innovation in other areas of the product umbrella, you call it, and that's the Nike running area. So this company's already doing a great job of improving that part of the business. The Nike Vomero 18 is off to a great start. Pegasus Premium off to a great start. You know, the running aspect of this business up high single digits in the last report in the quarter. That's all bodes well from I guess a mosaic that tells you better product is coming, the consumer is responding, full price sell-through is improving, and that should just lead to better improved fundamentals in the quarters ahead.
Which company should be most afraid of a Nike turnaround story that is also within your coverage?
So look, we have a hold rating on holding, no pun intended, I guess. But you know, look, On Holding has done a great job over the last few years, growing dramatically. But that business has also gained from Nike's pain, right? So when Nike exited a lot of wholesale doors or pulled back dramatically from existing doors they stayed in, that opened up a real opportunity for On Holding to gain shelf space. So I think there's a little bit more caution to be paid there. We have a hold rating because the valuation is full in our opinion, but that's one name to be wary of. Our biggest short call, our biggest sell rating has been and continues to be Lululemon. Now, obviously, Lululemon doesn't produce footwear in any meaningful manner, but you know, the apparel business for Lulu, which is obviously its bread and butter, has been under pressure from others like Alo and Vuori. And with Nike getting its act together, not just in footwear, but in apparel, I think that also creates more issues ahead for Lululemon, which is going up against multi-year highs in revenue per foot and margins, which will be, I think it's undoing in the next 4 to 6 quarters.
Yeah, I take some swift steps back towards that. We made too much rack anytime I go into Lululemon, and I look for discounts across all the retailers. That's just me, frugal shopper.
Yeah,
Randy, thanks so much
great.
for taking the time.
Thanks for having me.
We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Time now for our chart of the day. Ryan Dietrich, Chief Market Strategist at Carson Group, posting this chart to social media this week. With stocks rising to a new record, we're looking at the historical pattern of peaks, and if history teaches us anything, potentially could be more room to run into the second half of the year. So this is where we're taking a look at when stocks historically peak. And guess what? The lion's share of that is typically in Q4 and spills over into January. You see the most typically in December and January of peaking for the S&P 500 annual highs. This is run from 1950 all the way into 2024 here, of course, because we haven't finished out 2025 yet. But as we're taking a look at some of the areas, of course, in the midst of this summer movement, one of the things that I want to take a look at is, of course, as we were taking a look at that chart, we still do have some of the most recent all-time highs, but if history is any guide, then some of these highs that we're seeing for, names like Nvidia, where that's up 1.6% here, and then ultimately continues to chart its own new highs. I'll put this on a year-to-date view. There we go. As you can see, the stock is up now 17% year-to-date and has moved off of those lows that we saw on the back of some of the move lower post-Liberation Day. And now, as we're seeing some of those trade deals start to be netted out, in here as well, you saw trips from Jensen Huang overseas, so Nvidia powering some of those new all-time highs. And then additionally, one of the other areas of the market that we've seen a lot of those highs continue to proliferate as well, Palantir, even though it's down here on the day by about 5%, year to date, take a look at that move. It's up 83% here. That has been one of the stocks that's lighting up the Yahoo Finance trending tickers page on a daily basis. And then elsewhere within the Mag 7 names, we were talking about Amazon earlier, and that one also up year to date, flat, just barely to the upside. Still has yet to creep back to some of those previous all-time high levels that we saw earlier on in the year. But one of the things to continue to track with Amazon, Google, Meta, and Apple, and those other Mag 7 names is where there is a continued diversification effort that investors are looking for if they are trying to seek out any areas of the market that have been underappreciated or lagged the rebound performance. You could see some piling in or some additional rotation or taking bites out of some of those names, and we will see exactly where that leads the investor sentiment and ultimately how that can continue to push us to even more of a broadening and thus potentially more all-time highs. So that is something that we're tracking in today's chart of the day here. And then just lastly, let's see how these sectors have played out over the course of this year as we're now getting back to some of those all-time highs. I'm going to put this on a year-to-date view for us. And as you can see, we still have a few of those names, 3 of those sectors in negative territory this year. And don't look now, but it's consumer discretionary that still has some room to try and get back in order to get into positive territory this year. But industrials certainly has been catching the eye of investors, and that's up by about 11% year to date, leading the S&P 500 11 sectors. Well, switching gears, Tesla's latest sales numbers due out soon. The EV maker contends with continued demand weakness and brand issues surrounding CEO Elon Musk's time working for Doge under President Trump. Here with what to expect from the numbers, we've got Yahoo Finance senior autos reporter Pras Subramanian. Pras, what do we know?
Hey, Brad. So another rough quarter for Tesla's core auto biz is sort of expected for Q2. So looking at the expectations as tabulated by Bloomberg, expecting around 395,000 deliveries for Q2. That's down 11% from a year ago. Production of around 405,000 also down. This is the new Model Y is on sale in most territories in the world. But this shouldn't be seen as a surprise, right? These lower numbers. We've seen weakness in Europe in April and May, also weakness in the US via registration data, which is sort of a proxy for sales. So, you mentioned that Musk is now away from politics. He's sort of gotten back to his quote unquote main quest. Will people forget about his foray into politics? I don't think so. It's still kind of fresh right now. He's still tweeting about a number of things like that that are not germane to the auto business. But, look, most of Wall Street is bulled up on the robotaxi test, right? That's happening right now in Austin in a very limited nature. If that goes well, if we see more of those cars on the road, maybe that'll help the bull story. Because the stock is not doing so bad compared to how bad deliveries have been in Q1 and potentially in Q2.
And at the same time, you've got Tesla's head of manufacturing, Omid Afshar, has reportedly been fired by CEO Elon Musk. Yahoo Finance reached out to Afshar and we received a bounce back. Afshar reports directly to Musk and just this week thanked him on social media for, quote, pushing us all in reference to Tesla's robotaxi launch. Pras, what do we know and how close was Afshar to Musk?
So Afshar was potentially sort of brought on in the company. This is according to Walter Isaacson's book on Musk. Brought on in the company, a favorite of Musk's, was in his sort of CEO office as almost a de facto chief of staff. And then because he trusted him so much, he expanded his role. In this case, oversaw the development of the Austin plant, which is a big deal. So kind of had a manufacturing title there, but he's still mostly reports directly to Musk, and he was like a Musk favorite. So seeing him sort of drop in the reporting, I think Forbes reported that he actually was fired by Musk. And it's sort of in line with seeing the weakness in the auto biz. Is that possibly why, or did Afshar leave on his own? Unclear, because obviously Tesla does not respond to media requests. And I emailed Omid earlier today and got that bounce back that said the email is no longer active, meaning it was at one point, not anymore.
All right, Prost, thank you so much. We've got to leave the conversation there. Coming up, how ETFs provide an unexpected way to add tech and industrials to your portfolio. That's next. NATO leaders committed 5% of their annual budgets to defense spending at their annual summit this week. And while defense stocks have cooled since the recent spike, ETF flows suggest the defense rally still has some room to run and could even be an alternative way to play the tech trade. I want to bring in Cynthia Murphy, Vetify investment strategist, for this week's ETF report sponsored by Invesco QQQ. Great to have you here in studio with us. So let's just begin. Why are we seeing some of these inflows, and to what extent is it analogous to events that we've seen in the past where there is a ramp up in some of the defense prioritization among investors?
You know, when it comes to thematic investing, defense has been one of the biggest themes so far this year, outside of protection, things that we're going to talk in a minute about. And, you know, the news keeps supporting this as a good area of the market to be in. So defense stocks are primarily industrial plays, but a lot of them have more and more tech stocks because defense today is both an industrial infrastructure effort. It's also a technology effort, an AI effort. When you think about drones and all the new technology you're using for combat. And this week we had the NATO news where they're really upping their budget for defense spending. They went from 2% of the GDP commitment to 5% GDP commitment. And not only that, but these countries have to actually show on an annual basis their plan. How are they going to allocate that budget? How are they spending that money on actual defense equipment and strategy? So it's a theme that just keeps on giving. I mean, some of these stocks, Rheinmetall, which is one of the biggest defense stocks, it's a German company, is up over 250% in the last year. Yeah. These are really, really strong performers, and investors are buying the ETFs that tap into that space.
Well, and Simeon, Cynthia mentioned a great point in that the battlefield is very different right now, because especially with some of the foreign actors that might try in times of conflict to tap into things like energy grids or natural resources. That also takes the mindset to what needs to be done within cybersecurity, what is already being done, and where investors could also be thinking of that as an annexed defensive play.
Yeah, I think maybe one of the questions is how insulated are these companies from the broader economy? Let's take the NATO uptick in spending. let's make kind of a bear case that they can't quite run deficits. We know they said they're going to run bigger deficits than they have in the past, but they can't do it like the U.S. does. So let's suppose they keep their commitment, but it takes a nick out of their broader GDP growth. Are the defense names and the cybersecurity names narrow enough to benefit without the downside of perhaps a little touch of weakness in other parts of the European economy?
I think it remains to be seen, but if you think about, I mean, we're talking arms dealers, we're talking about, technology, airplanes, like in the US would be like Lockheed Martin, Northrop Grumman. I mean, they're different companies that are, kind of swimming above that pond because that market is so strong right now. And I think the especially strong plays here are Europe-based plays more than the US because it has really been that effort there. So when you look at funds that invest primarily in Europe defense, like EUAD, that fund is up 65% so far this year. When you look at, say, SHLD, a shield, which has 50% US, 50% global, that fund is up maybe 50%. So really the play really is the European companies because they are committed to investing in these businesses and making it happen.
One of the other areas that you flagged to us as well, gold miners, still one of the year's best performing ETFs. What is the outlook for the second half of the year, given that we'd already seen some of the highs that were just mind-blowing that we were able to get to, and how much of those flows could still see momentum from here?
Yeah, Simeon, we've been in this business long enough to know that gold miners ebb and flow. It's like almost every 5 years they have their moment in the sun and then nothing happens.
And they don't always do what gold does.
And then they bust.
Yes.
This year they're outperforming gold 2-to-1, basically, 60% to 30%. All the conversation, JP Morgan just came out and pegged the price of gold at $4,000 by mid next year, which is another big leg up from where it is today. And if you look at Q1 earnings, I think that's a big catalyst here is Q1 earnings show these companies beating their earnings.
Yeah.
Big amount, like Newmont, I think beat earnings per share by more than 30%.
Yeah.
So they are really resilient and they're doing well and folks are buying in.
We got to leave the conversation there. Simeon, I know FB, QB, RB, they're all, of course, football names here. Those are some of the new ProShares ETFs.
We launched a suite of dynamic buffer ETFs yesterday.
Yep. Yeah.
Great opportunity to have downside protection, upside participation, dynamic, daily.
Right.
You don't have to worry about when you go in and out,
yes.
And you get more protection when you need it.
Coming up, everyone, full market coverage ahead. 90 minutes into the start of the U.S. trading session, let's get a check of the markets. I'm Brad Smith. You're watching Yahoo Finance, taking a look at the major averages. We've got them there on screen for you. The Dow Jones Industrial Average up 0.8%. S&P 500, you saw that notch a new record high intraday today. And we will see exactly where we close on the session. We are still holding on to gains, though, of about 0.5%. And the Nasdaq, you're seeing that up by about 0.4% right now. Let's flip on over to the bond market, taking a look at the 5, the 10, and the 30-year yields. We are looking at gains of the yields across the board, about 4 basis points for the 5-year, 2 basis points for the 10-year, and then additionally, the 30-year yield is up 1 basis point. As we're continuing to watch this play out in the market, you're watching Market Catalysts. I'm Brad Smith. 30 minutes as we are much more than 30 minutes into the U.S. trading day, 90 minutes into the U.S. trading day. Here's some of the catalysts that we're watching this hour. S&P 500 and the Nasdaq opening at record highs. We bring you the market outlook with stocks powering higher. Plus, we break down the outlook for rate cuts as the Fed's favorite inflation gauge comes in hot. And we bring you the stock to watch this hour as Nvidia, Tesla, and Nike are all on the move. The why behind the highs straight ahead. Trading at record highs, Nvidia's market cap is nearing $4 trillion, overtaking Microsoft. And Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research, predicts it won't stop there.
And I think investors are starting to recognize we haven't even seen the biggest growth driver yet of AI, not just on enterprise and the use cases, but on the consumer side and ultimately autonomous and robotics. And this is, in my view, it's not just $4 trillion. I mean, we're going to be looking at a $5 trillion market cap in Nvidia.
And here with more on the catalysts continuing to push Nvidia stock higher, we've got Yahoo Finance tech editor Dan Halley. Dan, what do we know?
Yeah, Brad, there's a number of things going on here. First, I want to shout out Dan Ives for that New York Mets pillow in the background. But there's a number of things going on around NVIDIA that are really helping to power the stock. And let's just start off with the big one, and that's the continued investment from hyperscalers in their data centers. So we've heard more about things like the Project Stargate from OpenAI, as well as Oracle. NVIDIA is a big part of that. Microsoft continues to purchase these GPUs. Google, Amazon, Meta, XAI, they're all gearing up and buying these and continuing to do so. And that's despite the fact that we were talking earlier in the year about the tariffs potentially having an impact on the build out. Maybe they will, maybe they won't change their path, but they seem to just be continuing to move forward and spending. One of the other things that's worth pointing out is sovereign AI. That's something that Project Stargate in Saudi Arabia is part of. When you look at how NVIDIA was received at GTC Paris, a lot of talk about sovereign AI and getting Europe's AI up to a caliber similar to what you can see around the US and China. So a lot of countries are leaning further into the idea of having their own sovereign AI, not necessarily relying on the AI capabilities of other countries. There's also the broader push towards powering inferencing. At first, when the big kind of generative AI boom kicked off with ChatGPT, it was all about training. And that's basically teaching these models what to do, what they'll predict next, how to write, based on millions of books, generate images, things along those lines. Now it's about inferencing. It's about taking those models and putting them to work. And so the original thinking was, well, the training uses a lot of power. You need heavy duty GPUs for that, not inferencing. The opposite's proven to be true, where you need those heavy duty GPUs to continue to power the inferencing because it provides a better answer and better response from those bots. And then the last thing is NVIDIA's continued belief in physical AI. Now, that means basically robots, and that includes self-driving cars. And so they have a large footprint there in the self-driving car space, but then also Jensen has been pushing this idea of actual robots working side by side with people in factories at first, and then down the line in the future, maybe having them in your home. That's not going to come for quite a while, but NVIDIA's well positioned here because A, they have a small computer that they can use that powers some of these robots. I've seen a number of them in person. The other is that they have the capability to train them up. So using a virtual world where they teach the robot how to kind of get around and then implement that in to the actual robot in the real world. So going from virtual to real and then sorting out the bugs from there. So there's a lot of positives around NVIDIA. Obviously, since it's such a big name stock, there will continue to be ups and downs, but this is why it seems to be on that upward trajectory generally.
And so that upward trajectory, a lot of the analysts that are covering the name believe that it could be the first company and be on the it's in the pole position essentially to get to $4 trillion. So we've even heard upside of $6 trillion from some of the most bullish calls out there on Wall Street. What do you think the broader kind of analyst consensus is really settling around right now, Dan?
I think it's really the fact that, look, NVIDIA is still the go-to for these kind of capabilities, right? They're the ones that build these GPUs, are the ones that offer the software that are being used most often. And yes, there are competitors. AMD is continuing to develop and kind of work to catch its stride alongside NVIDIA. We have NVIDIA's own customers, Microsoft, Amazon, Google, working on and deploying, already using their own AI chips. The thing is, while they may use their AI chips, their customers, their cloud customers, still want access to NVIDIA's GPUs. And so they have to offer NVIDIA GPUs to ensure that their customers are getting what they want and continue to return. So I think that's where a lot of that kind of exuberance around NVIDIA comes from, is they are still the chip leader, despite the fact that there are continuing threats and growing threats from not just their ordinary competitors, but the people that they actually sell directly to. And by the way, just quickly, NVIDIA's also doing the flip side of that. Cloud providers allow you to get access to NVIDIA's GPUs. NVIDIA's also working with companies to provide cloud access to its hardware as well. So it's kind of like, look, we're business partners, we're pals, but at the end of the day, we're working out for ourselves.
Yeah. All right. Well, we're going to be watching closely to see within these trade deals, especially U.S. and China, where the IP potentially does continue to be something that Nvidia has to think about. That has certainly been one of the hangups here. We do know. Dan, thanks so much for breaking this down. Coming up, oil prices are set for a weekly loss. Will declines continue, or is more risk on the horizon? Things are up right now. We'll discuss next. Oil prices are set for their steepest weekly decline since March of 2023 as the Middle East conflict failed to significantly disrupt supply in the region. What's next in terms of catalysts for crude? Joining us now to discuss is Vikas Dwivedi, who is the Macquarie Group Global Energy Strategist here. Great to have you here with us. You know, one of the things that we're tracking, of course, week over week at least, is perhaps the relief that things are not as bad as they could have become within the Middle East conflict, and thus the impacts on the oil markets as well. What's your read through here?
Yeah, agree with your comment that it didn't turn out nearly as bad as it could have. Now, what we think is it should have come out the way it did. So it's not surprising that we're ended up here, but there were really credible scenarios where it could have ended up in very bad shape with a much longer military engagement between Iran and Israel, and a either destruction or disruption of oil facilities in Iran, and then the potential reprisal from Iran to other regional oil producers, or of course the Strait of Hormuz. So there were a lot of things that could have easily gone extremely badly for oil price and oil supply.
And so with this in mind, you are bearish on crude, and your answer there starts to spell out why, but take us deeper into why other investors out there might also be singing to a similar tune.
Sure. The big thing right now is we're in a big oversupply. The way we're counting the barrels, it looks like we're 1.5 to 2 million barrels a day oversupply right now. And if we look forward, over the next few months, what were some of the things that were supposed to happen? Iran was supposed to go down on production. They're probably going to stay flat or even go up a little bit, especially based on the recent announcements from the Trump administration of Iranian oil to China being okay. And the U.S. probably is firming up its own production growth, which was at risk, not but a few weeks ago when we were nearing 55 WTI. The U.S. may have fallen, and now it looks like with the amount of hedging that was done recently at higher prices, the U.S. should deliver pretty good production growth. How good? To the tune of 500,000 and even up to 600,000 barrels a day on an exit basis this year. Brazil is ahead of schedule, far ahead of I think where the market was. Everybody knows Guyana is in good shape. So, not to list them all out, but there are a lot of good production growth stories. OPEC will still be coming back, right, with another 400,000 or 500,000 barrels a day over the next few weeks. Once you start piling that on, we start heading into extremely big surpluses in the global market.
So what is the market focused on right now? The biggest headwind in this climate from your own assessment? And on the other side, is there a tailwind that we should be anticipating to the upside? Because, it's hard to imagine that there would be a tailwind to the upside if there was more of the kind of drill, baby, drill that President Trump has talked about, because that would actually just further impact some of the very oil companies that are looking to securitize margins and have the fiduciary duty as well to their investors to kind of hit some of their own expectations on that front too.
Great points. What we think is that maybe there's not a good tailwind, but there are things that will limit the downside. What we've analyzed, and in our supply demand balance, the surplus is so big that you could have a unmitigated down move. It could go down to, some really unbelievably low price versus what expectations have been. But what I think will stop that is the fixes, right, to low price, fixing low price. The Chinese will start buying a lot more strategic petroleum reserve barrels on their part. They can buy, we've seen them buy 1 million barrels a day. So that's a huge sort of a safety net for the price of oil. You'll get a better demand. You'll get some diesel getting in front of natural gas, maybe 200,000 barrels a day globally there. And the U.S. will slow down on growth, and OPEC can tap the brakes on how much it's returning to the market. You start adding those up, and you get a fix to the oversupply that will be compelled by low prices.
This, of course, is one of the strongest demand periods of the year cyclically during the summer for gas and for oil. So how are we on a comparative basis, even now kind of removing the conflict, how are we on a comparative basis year over year towards what we would typically be seeing?
So you're right. This is the one of the peak periods for oil demand. We're doing okay. You know, considering the trade war and all the concerns about macro recession risk, the demand picture has actually held up better than expected. But we still think the pain from the tariffs and the trade war is still to come. We've lowered our demand numbers from about 1.1 million a day for the full year to roughly 800,000 barrels a day. So that's not good, but it's not terrible. It's sort of in that zone in between. You know, could we have a positive demand surprise? Possibly. You know, if the ending of the trade war, meaning, you know, wherever it settles out at 15% average tariffs, you could get a little bit of an upside from our numbers. But if it goes the other way and you end up closer to 20 or north of 20% on the weighted average tariffs, you could still see a little bit of a drag on demand. So I guess to shorten up my answer a little bit, we just don't think that the real pain has been seen in the marketplace for demand because the trade war sort of took, you know, a back seat to Iran-Israel right now, but it will come back into the front.
Just one more small question while we have you here. To what extent should we anticipate any type of catalyst for the energy sector and the oil market, knowing that there's still multiple trade deals that need to be netted out and energy could be a component potentially in some of those deals?
Yeah, we think that'll be a big part of it. It is a good way to help the balance of trade with many countries. And we've got the energy. A lot of countries are big importers. So it's a natural fit, and it's way more seamless than redirecting other supply chains from other goods. So it should help the U.S. energy industry, both from production and logistics, everything involved to get our energy to other parts of the world. It would be something that would help the Trump administration achieve its goals. And I think it would be something that would, you know, personally be very satisfying to President Trump, because it would hit both energy benefits and the U.S. trade balances benefit.
Vikas, great to have you here with us today. Thanks so much for taking the time.
Thank you.
Simeon, I want to bring you back into the conversation here. The recent moves that we've seen in oil, plus the potential tailwinds or even headwinds that this market could face, and how that would pass through to some equity names as well.
I think the big story here is just how much more oil the U.S. makes. The U.S.'s share of global oil production has about tripled in the last 10 or 15 years, from somewhere around 5% to about 16, 17%. And there is no way, I mean, I'm old enough to remember that 70s stuff.
Yeah.
I mean, there is no way that anything in the Mideast would have happened 50, 60 years ago without oil going through the roof. But this time around, there's much more diversified supply. With regards to the equity opportunity, there's price risk, as we were just discussing. We've actually seen some interest in kind of a cousin or an adjacent trade to energy.
What's that?
Infrastructure, but in a very specific way. We have our ETF ticker TOLZ, and it's tolls because it's the owners of infrastructure assets, and a big chunk of that is energy distribution. You're a toll taker, so you're not quite as exposed to the fluctuations in price. As long as there's decent supply going through there, you can really benefit from the healthy levels of demand that I think we all see continued demand for energy, but since the supply's there, the price may be a little at risk.
That's a good consideration for investors out there. Simeon, appreciate that. Stick around. We've got a little bit more to discuss here on the other side of the break. We've also got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. About 2 hours into the start of trading, let's go live to the Nasdaq to get a read on the biggest factors moving markets today. Joining us now is Yahoo Finance's Ali Canal.
Hi, Brad. Well, I'm on record watch here, particularly for the S&P 500 and the Nasdaq Composite, because we are currently trading above those all-time highs. And as a refresher here, the S&P 500 needs to close above 6,144 to notch a new record. That was the peak back in December. And then the Nasdaq's aiming for 20,174, which would be ahead of its all-time high that we saw in mid-December. So again, we are easily on track to hit those highs. Of course, these gains will have to hold here, but really just a stunning and historic bounce back for stocks since those April lows. And here's what's helping boost markets today. The main catalyst, positive trade developments. We now have a deal with China on the table, and now Bloomberg also reporting that the European Union and the U.S. are optimistic that they could reach their own trade deal before that July 9th deadline. That's when Washington plans to slap 50% tariffs on almost all EU products, and the EU has said that they are ready to respond with their own countermeasures. Bloomberg referring to a closed-door summit that happened on Thursday with EU leaders who said there's a confidence there that a deal could be struck to avoid that costly trade war. Meanwhile, we did see some fresh economic data earlier this morning. We have PCE painting a more stagflationary picture, but consumer sentiment saw a boost in June. The index coming in at 60.7 for June. That's up from 52.2 in May and slightly beating expectations. The survey did cover a pretty turbulent time. We saw various protests across the U.S. when it comes to immigration policies, but economists now saying that the initial shock from Trump's tariff announcements, that has diminished. Still, we have confidence that remains about 20% lower than December 2024 levels as consumers continue to navigate a lot of these uncertainties. And to that point, the Fed has said that we should see some tariff-related price hikes later this summer. So confidence, can be choppy perhaps over the summer. We could see some choppiness, more volatility in markets as well as earnings season is about to ramp up. Maybe if we don't see what we saw in the first quarter, that could lead to some hesitancy in this market. But for now, stocks really looking past a lot of this noise and trading at those record highs, Brad.
All right, Ali, we're going to continue to track this throughout the rest of today's trading session. Thank you. Now time for some of today's trending tickers. We are watching Palantir, Pony AI, and Rocket Lab. First up, Palantir announcing a $100 million deal with the nuclear company. The startup is paying Palantir to develop an artificial intelligence operating system to make reactor construction faster, more predictable, and safer. In an interview with Yahoo Finance's Josh Lipton yesterday, Palantir head of defense Mike Gallagher shared the motivation behind this new partnership. Take a listen.
The unifying principle here is a alignment of mission, right? These are two companies that want America to dominate in technology, and there is no winning the AI race if we do not have nuclear technology and ignite a nuclear renaissance in this country, which is why Palantir is going to put the entire weight of our organization, our software, which we think is the best in the world, behind the nuclear company.
I'm going to bring back in Simeon Hyman, ProShares Global Investment Strategist, into this conversation. Simeon, one of the things that they marked with this partnership, saying it marks the first time Palantir software will actually be used to help power the next generation of nuclear energy infrastructure. On headline and on some of the details, how are you evaluating what this means for Palantir, which has been one of the hottest stocks over the course of 2025 already?
There are two things that strike me. One, earlier we were talking about incumbents versus innovators.
Yeah.
Okay, these guys are innovators. So while we do know that the Mag 7 are incumbents, there are folks like Palantir who are who are embracing the new technology. They are disruptors, and it's working. The other thing is that we need nuclear energy, and that's a powerful, powerful development. I mean, it is one of the unfortunate historical artifacts that because of things like 3 Mile Island that took nuclear out of the puzzle, that's one of the challenges in terms of a greener world. Nuclear is one of the cleanest energies, so that type of partnership with an AI interrupter and disruptor with our requirement for nuclear energy is a powerful combination.
Yeah, they say here, according to the release, the NOS will provide, which is the nuclear operating system, will provide schedule certainty, cost savings, problem prevention, and regulatory confidence here. And we'll see exactly how those large language models can rapidly review tens of thousands of documents, and AI agents get trained as well on regulatory requirements to validate the data recorded at these construction sites. That's part of the release. We'll continue to see how this partnership moves forward. Next up, Uber and its former CEO, Travis Kalanick, eyeing a potential acquisition of the U.S. arm of Chinese self-driving firm Pony AI, according to a New York Times report. The potential acquisition of the $4.5 billion company is in very preliminary talks, but if a deal is reached, it's likely that Kalanick would run Pony AI and maintain his CEO status of Cloud Kitchens. Uber's presence in these conversations highlights its concern over the rise in self-driving taxis, like those created by Alphabet-owned Waymo and Tesla, which could reduce the need for human drivers. Taking a look at shares of Pony AI and Uber, both of those are down on the day by about 4% for Pony AI. We'll round that off to about 3% for Uber. For Uber, they also have been hit by what has just recently rolled out days ago in tests for, of course, Tesla's autonomous taxi service as well. Scale, of course, is the larger question around some of these ambitious goals that each of these companies have for autonomous taxi driving right now.
Among the things we don't know, we all assume that X number of years from now that almost all the cars on the road will drive themselves. We don't know precisely who will be the owners of that market. Whether we don't know if the incumbent automakers can actually make a run of this, which we know they're working on as well, or whether it will be Uber or whether it will be Tesla. So I think those are open questions. And we also don't really know the economics of it. Are the margins for that actually going to be better than just making cars? It wouldn't be a shocker to me if we find out that it's more profitable, for at least for a little while longer, to just make a regular car.
Interesting. Finally here, we're also watching Rocket Lab announcing with the European Space Agency a deal over 2 satellite launch orders. Liftoff for the prototypes of the satellites are planned for December of this year and aim to test low Earth orbit navigation and timing. The European Space Agency says Rocket Lab was selected because of its quick time to turn around and small satellite development skills, which should help the ESA to meet its spring 2026 deadline. They're taking a look at Rocket Lab shares, up by about 1.3, 1.4% a moment ago. And this is a company that moves in tandem with some of its successful launches and government contracts that it's able to see with any part of the world, that those contracts start to make themselves known within as well.
We've got a couple of moving parts in different directions because we know we have the potential for less spending from the U.S. government. But of course, now we have this commitment on the NATO side, and not just the NATO side. Remember, just a couple of months ago, we heard all of that noise from Germany, which is now embarking on a much more expansionary fiscal policy, and some of these firms may very well be beneficiaries thereof.
Spot on. We're going to continue to track Rocket Labs throughout the rest of today's trading activity as well. And you can too by scanning the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're also watching shares of stablecoin issuer Circle falling today here. The stock has had a volatile week, set to close in the red for its 3rd full week of trading since its IPO. Yahoo Finance senior markets reporter Inez Ferre has the breakdown. Hey, Inez.
Hey, Brad. Yeah, and we are watching Circle shares right now under pressure, down 10%. It has had a wild week. I am going to show you, though, the gains since its IPO on June 5th, more than 500% since that blockbuster IPO, despite all of this volatility. A lot of these gains have been fueled by the Genius Act that was passed in the Senate recently. This has been fueling optimism for broader adoption. This would set guardrails around the whole stablecoin industry, which the stablecoin industry, there's so much enthusiasm about it because it's supposed to be sort of revolutionizing the way payments are made. Seaport Global earlier this week put a buy rating on this stock and a $235 price target. The company makes most of its revenue from reserve income, and that's what it makes on the cash that backs its stable coins. And most of those are invested in short-term treasuries. This is important. I'll get to it in a second. Now, some analysts have been warning about rising competition on the heels of this Genius Act, which is expected to be finalized by later this year. But also another headwind would be if interest rates were to be cut, then you would see the money made on those treasuries that would be lower. So that's some of the headwinds that Wall Street has been pointing out. But I do also want to stress what analysts time and again have been talking about, and this strategic importance or collaboration between the government and the stablecoin industry, because these stablecoin issuers, Circle and Tether, are huge buyers of short-term treasury bills. So they're huge buyers of U.S. debt. And JP Morgan is projecting that stablecoin issuers will become top buyers, leapfrogging other countries. So this is massive for the entire industry. And this is why many on Wall Street are bullish that the stablecoin industry is just getting started, because of the U.S. government will want to collaborate with some of its biggest buyers of its short-term debt.
Yeah, it's certainly been a run for Circle since its IPO here. We're going to continue to watch what some of that demand looks like for stablecoins, and Circle has found itself at a centripetal force type of position within that conversation right now. Inez, thank you.
Thank you.
All of your markets action ahead. Stay tuned. You're watching Market Catalysts. Robinhood's co-founder Baiju Bhatt stepped down from his executive role at the fintech giant last year to pursue a new endeavor, a space-based solar energy company called Aetherflux. Our very own Brian Sazi got a chance to sit down with him to discuss the company's mission as well as his role on Robinhood's board. Take a listen.
The mission is to deliver energy to planet Earth. So what does that mean? So we're taking this idea of space solar power, which is an old NASA idea, Department of Energy from the 70s, of collecting solar power in space and beaming it down to the ground as an alternative energy source. Wild idea.
Very wild. So if you pull off what you're trying to pull off, and I hope this doesn't sound really simple and borderline dumb, would we need solar panels anymore on people's roofs? Is that what you're trying to get rid of?
I mean, I think it's a technology that kind of both is very complementary to that and also is in many ways like a direct competitor to that. So when I think solar panels on roof, like those are useful in some capacity to people. But I think the idea of having these really large solar farms on the ground that take up a tremendous amount of land, that have adverse effects on the ecosystem underneath where the solar farms are, right? We can actually take that infrastructure and put it in space. This is kind of what our idea is. And instead project down a beam of power that uses way less real estate on the ground. So maybe it's a good time to just kind of broadly explain what the idea is.
Yeah, please.
So
no pun intended, far away. Yeah.
Far out, actually. We have solar panels in space. You have the sunlight from the sun that hits them in space. And the cool thing is that if you put it in the right orbit in space, you can have your satellite either continuously illuminated or illuminated a really large percentage of the time, and you get a constant amount of sunlight energy. So that sunlight energy is then converted to electricity on the satellite, and it's either stores the electricity in batteries or directly transmits that electrical power to the thing that transmits the power down to the ground, which is an infrared laser.
You're still on the Robinhood board. You know, the past 2 years, I have marveled at what Robinhood has done. Culturally, the company seems different. The top and bottom line results are different. They actually won our Comeback of the Year award last year. Has visions of potentially being a future JP Morgan acquisition. Like, what was there a turning point inside of Robinhood that could help explain why the stock now near at a record high? Like, did something happen?
I think we've been pretty focused on the mission from the beginning, right? And I think that's kind of been this sort of North Star, kind of coming back to the parallel to Aetherflux, right? The mission of democratizing finance for all. I think it's one of the things that motivates the company and motivates a lot of the decisions that we make there. And it's just been like really hard work and execution year in, year out. I think from my perspective, having co-founded the company with Vlad, I kind of see like all the little steps along the way and kind of the hard work it took to get to every one of the different steps. And yeah, I'm proud of the execution.
Coming up, stocks are in record territory. Why? One financial advisor says diversification still matters, despite the rally. Stay tuned. The S&P 500 and the Nasdaq are both in record territory today, but my next guest says that diversification, yes, it still matters. I want to bring in Catherine George, WealthStream Advisors financial advisor for this week's FA Corner, brought to you by Capital Group. Great to have you here with us, Catherine. First and foremost, diversification, yes, of course, still matters, but are there surprising areas of the market that have shown you resilience in that diversification strategy?
Yeah, I think it's really exciting to be able to talk about diversification because over the last 10 years, the S&P 500 has been a consistent top performer. And I think because of that, investors have become more concentrated in the S&P 500 and more focused in that area. But what's been happening this year is that the S&P 500 is only up about 4%. Whereas international developed countries are up closer to 17-ish%, and emerging market countries are up about 15%. So by the time that you see these numbers, these countries and areas have already rebounded, which is why it's so important to be invested from the beginning and not get so focused on, what has it been doing for me lately.
It's interesting, and we were talking about this in our morning meeting this morning. I raised this question of the S&P 500. It's got 11 sectors in it, so you've got some pretty good diversification already. But if that is not diversified enough for you, how else should you be looking across the assets in your portfolio to make sure that it's well-rounded?
Yeah, so the S&P 500 is still only a small portion of the U.S. Companies. So those are the top 500 companies. You can even look to medium-sized companies and small-sized companies in the U.S. Of course, those international companies that I just talked about are really important, but also bonds. So, if we compare the news cycles and the volatility to earlier in the year, things are a little quieter right now. And I think that people put their portfolios out of mind when things are quiet. But I actually think it's the best time to reevaluate your longer-term needs, your longer-term goals. Do you need cash? Is this stock to bond mix appropriate? And it's contrary to what we might think, because when things are in turmoil or volatile, we want to take some sort of action, but it can oftentimes be the worst time to do that. So I think actually now is a great time to reevaluate. Just like you said, am I diversified enough? Do I have the bonds, the types of bonds, all of the different types of equities in my portfolio that I should, and really evaluate that risk.
Where do small caps, mid caps and small caps fit within that strategy?
Yeah, so they're going to be more volatile, right? If you're going to buy a smaller company in the U.S., there's more risk because it hasn't proved itself yet. But that means the expected return over long periods of time should be higher. I want to make more money on a company that hasn't proved itself. So smaller sized companies that really haven't proven themselves, those are actually also. It's an interesting sector to look at because things have kind of shifted to private markets on the smaller company side. So many small companies aren't going public, or as many as there used to be. So there is still a public market, but if you're interested in diversifying further, we've also been looking into some of these private equity strategies. But it is for a smaller portion of the portfolio and a longer term portion of the portfolio because it's illiquid. But it has become more accessible to the everyday investor.
How can an investor find diversification in new companies that do make their way into the public market? They make that debut, but ultimately there might be a checklist that investors need to run through in their mind as to whether or not it is a ripe opportunity or one that perhaps still has a little bit of a sour road ahead.
Yeah, so if you're going to look at an individual company, it's really a bet. It's either a home run or it's going to be, a fail. And so those are really lottery tickets. And there's no way to know for certain which ones are going to, be the home run. But when I look at for our investors, how can we capture that market without making these big bets and risks? if you own the whole market in an ETF or a mutual fund, those will get captured over time. So you'll be able to experience the wins. You won't feel them as much, but for the ones that don't win, you won't feel that as much either. So that's an easier way to get introduced to some of these smaller companies.
Catherine, thanks so much for taking the time here with us today.
Of course.
And that was FA Corner, brought to you by Capital Group. I want to bring in my guest contributor, Simeon Hyman, ProShares Global Investment Strategist, for some final thoughts as we wrap up the hour here. And we've discussed a range of topics. And perhaps if we were to look back and summarize the first half of the year, what grade would you give it, continuing to evaluate everything that we've had to move through here?
It's an amazing event the first half of the year. It's like we dodged a bullet. And I think this diversification conversation we just had really puts a pin in it, because diversification is incredibly important, but it doesn't always work. And remember in April, the beginning of April, stocks and bonds sold off together.
Right.
And remember in 2022, when for a whole year stocks and bonds sold off together. And this notion of how do I manage risk? Stocks and bonds don't always do it because they can be correlated. That's what drove this explosion in the buffer ETFs in 2022. The limitation there is you're using the option market to shape returns, but you're telling people in a classic defensive buffer strategy, you got to go in on January 1st and then you got to hold it for 365 days. But now we have daily options. And the daily options are a powerful augmenting tool to diversification. It's why we launched our dynamic buffers, to have a buffer strategy that works on a daily basis, because diversification with stocks and bonds doesn't always work.
And so what does that mean? How should investors be thinking about a dynamic buffer, especially as that's something that you at the ProShares team as well have looked at and clearly sense that there's demand for that ability for investors to be a little bit more nimble long-term here?
That long-term is key, because what it does is the strategy helps you stay in your chair. You don't capitulate in April. And what we've put together with our suite, FP, the S&P 500 dynamic buffer, QB, the Nasdaq 100 dynamic buffer, and RB on the Russell 2, it does two things. It establishes the buffer every day, but also dynamically reacting to volatility, more protection when you need it. And it can be a really nice tool alongside diversification to help you stay in that seat and participate in equity markets over time.
I got 20 seconds left. Top 3 checklist items that investors should keep on their radar for the second half of 2025.
You got to watch earnings, and you got to watch inflation. And I want to make my third thing something you shouldn't look too much at.
What's that?
Don't get too worked up about the Fed. The long end of the curve is probably going to be stable.
Simeon Hyman, thank you so much for sitting in on the show with me. We appreciate the time and insights.
Thanks for your time.
It's been great. We got to get some guitars and some drums out next time.
Absolutely.
You guys missed our entire conversations in the break about our own musicianship, but we'll save that for another day. We appreciate it. Everyone, that's it for Market Catalysts. I'm Brad Smith. Thank you for watching. Take a look at the major averages as we ride out into the close of the show. The Dow higher by about 1.1%. The S&P 500, oh yeah, we're on some new all-time high watches there, folks. That's up 0.7%. And the Nasdaq Composite, you're also seeing that higher by about 0.7%. Much more Yahoo Finance later today.